Lecture 5. The Fine Print.
If loan contracts make you nervous or suspicious, then you're in good company. I'd guess that most of us have signed off on loan contracts that we don't completely understand, myself included. But remember what we learned in the very first lecture of this course. Every financial instrument is based on some kind of contract. So if you're going to be using any kind of financial instrument as a borrower, lender, or trader, you need to understand the contract associated with that instrument. If you take the time to learn about financial contracts, you'll find that most of them really aren't that complex. Understanding what's actually in a contract can make you more comfortable with using financial instruments and better able to judge whether a particular contract really does contain provisions that you don't want to agree to. In this lecture, we're going to take a closer look at financial contracts. Technically, we can put just about whatever we want into a financial contract. After all, it's simply an agreement between all the different parties. But at the heart of just about every financial contract is a simple exchange or sale. Generally, one party to the contract gives cash to the other party now, while the other gives something of equal value in exchange. The item of value can be just about anything, but there are a couple of common categories. The first category is an ownership claim on something like a business or a building or even a portfolio of securities. You may remember from the first lecture that one of the main jobs of financial markets is to help people pool money and divide up the ownership of large and expensive assets that people can't afford themselves. Whenever we pool resources like this, we need to have some kind of contract that lays out who owns what and what each owner's rights and responsibilities are. The second type of valuable item is a promise to make cash payments, or possibly non-cash payments too, sometime in the future. The key part is the promise to deliver something of value later rather than now. This, of course, is the basic arrangement behind lending. The lender gives the borrower cash now, and the borrower gives the lender a promise to make a set of cash payments in the future. The set may include only one large cash payment, but it usually includes many smaller payments, like loan payments. It's important to keep in mind that whenever a financial contract calls for an exchange, both sides are agreeing that the two things they're exchanging are equivalent in value. So when you take out a loan of $200,000 to buy a home, the lender is saying that your promise to make the mortgage payments on the loan for the next 30 years is worth $200,000. Well, that should make you feel pretty good. Part of the reason why the lender is willing to accept your promise to make those payments is that you're agreeing to pay a lot more than $200,000 in total, and the lender stands to earn a lot of interest on that transaction. Presumably, you're agreeing to do this because you've thought it over, and it's worth it to you to pay the interest rather than wait for many years to save up the money. What this example illustrates is that many financial contracts involve putting a money price on a financial asset that may be actually fairly difficult to price for both the lender and the borrower. A lot of negotiation and a lot of math may have to be done by the two sides before they're able to agree on the exact terms of the contract. But don't worry, you don't have to know all the math to be comfortable with the contract. One of the most common financial contracts is the promissory note. As its name suggests, it's a contract in which one party is promising to transfer something of value to another party at some future date, presumably in exchange for something of value today, although it could also be in exchange for something in the future as well. The promissory note is the basic document behind every loan, and many other financial contracts are also variations on the basic promissory note. One of the main parts of the promissory note is a section of information that describes what is being promised. These are the detailed terms of the loan. This part of the agreement states how much the borrower is receiving from the lender and how the borrower is supposed to repay the loan. These details include how much each payment will be, how often the payments will be made, and for how long. In addition, the interest rate on the loan is stated explicitly. We have a specific description of what each party is receiving in this exchange. Now, you might think that once we've outlined the basic terms of the promise, who gets what, the promissory note is finished. But we're really just getting started. The next part of many promissory notes is actually many times longer than the description of the promised payments. This part is a set of covenants. Covenants are additional conditions that one party requires the other to fulfill as part of the overall contract. They're additional promises that one party makes to the other. Usually, it's the borrower making promises to the lender. Covenants are necessary because of what we learned in a previous lecture, the problems caused by asymmetric information, especially adverse selection and moral hazard problems. Because the lender won't be able to observe the borrower's type or actions perfectly, the lender requires the borrower to make a set of promises that help to protect the lender from being taken advantage of. Covenants come in two basic flavors, positive and negative. Positive covenants require the borrower to take some kind of specific action. For example, many positive covenants require the borrower to provide information to the lender, which helps the lender monitor the borrower's activities. In many cases, this information simply helps the lenders update their understanding of the borrower's capacity to repay the loan. For example, every business loan requires the borrower to give their lenders financial reports on how the business is performing. But borrowers are also required to disclose information about their actions that may have otherwise been hidden from the lender. For example, borrowers may be required to report to their lenders any new investment or business deals above a certain value. Other types of positive covenants require borrowers to post collateral and maintain that collateral in good shape. In the lecture on information, we learned that collateral helps reduce adverse selection and moral hazard problems, but only if the collateral actually has value. So the positive covenants in a promissory note require the borrowers to take actions that benefit the lender by increasing the probability that the borrower will repay the loan. Negative covenants, not surprisingly, require the borrower to avoid doing certain things. For example, many loans place limits on the amount of additional borrowing that the borrower can do until this particular promissory note is fully repaid. Taking on additional debt, by the way, is related to that asset substitution problem because it raises the borrower's overall riskiness. The more debts you have to pay, the higher the chance that one day you won't have enough income to make all your payments. Negative covenants are usually aimed at the moral hazard problem by ruling out specific actions that borrowers could take. Most promissory notes have at least a small set of covenants, and many loans have a big set of covenants. For many business loans and bonds, the covenants run to dozens of pages of do's and don'ts. And as you might suspect, it takes a lot of effort for borrowers to comply with all these covenants. So much so that they consider covenants a significant added cost to the loan. During the middle part of the decade between 2000 and 2010, when lending was expanding at a dramatic pace, many lenders began to decrease the number and the severity of the covenants they made borrowers agree to, as a way to attract more business. This so-called covenant-light lending was yet another reason why the financial crisis was so severe. Without as many covenants in the promissory notes, business lending was subject to more of the adverse selection and moral hazard problems, and then more borrowers defaulted when the economy turned down. Of course, after the recession hit, those covenants came right back in fashion. The final part of the promissory note has to do with enforcement. What happens if the borrower doesn't make the payments in full and on time, or violates one or more of the covenants? Well, part of the promissory note will be devoted to spelling that out. The enforcement-related parts of the promissory note specify the penalties for late payments, and they define the circumstances when the borrower will be considered to be in default on the loan. If the borrower has posted collateral, then this part of the promissory note will specify when the lender may take possession of the collateral. In many cases, lenders will also specify that if they have to hire a collection agency or other legal help in order to collect the missed payments from the borrower, they'll pass those costs on to the borrower. The enforcement provisions also include procedures and penalties dealing with violations of the covenants in the promissory note. One of the most common penalties is known as an acceleration clause, and it works like this. If the lender finds that the borrower has violated a covenant, they have the right to require the borrower to repay the loan in full immediately. That is, the lender can accelerate the repayment of the loan. Acceleration clauses not only give some teeth to the covenants, but they also protect the lender's interests by not allowing the borrower's hidden type or hidden actions to persist and further endanger the payment of the promissory note. So there you have it. A promissory note contains a description of the promise or the items that will be exchanged, a set of covenants, and provisions for enforcing the agreement. I realize that all this may be a little too theoretical, so I thought it would be useful to take a closer look at a common promissory note that most people deal with at some point in their lives, a car loan. What I've done is take an actual loan contract and simplify it a bit. I've dropped a few minor clauses and legal notices. I'm going to treat the loan as one large contract because effectively it is. You won't get the loan unless you agree to all the parts. But you'll notice that the loan contract is actually broken up into three separate agreements called the note or promissory note, the security agreement, and the truth in lending disclosure. Promissory notes that are written for individuals must comply with the Truth in Lending Act, and this helps to simplify the notes a great deal. The Truth in Lending Act requires lenders to disclose on one sheet many of the key requirements of the loan using language that's easy to understand. Well, relatively easy to understand. In addition, regulators urge lenders to use plain English in their contracts whenever possible. So most contracts that you'll encounter are surprisingly easy to read and understand. Here's what a sample Truth in Lending disclosure looks like for a car loan. The information at the top of the disclosure includes all the numbers that describe the loan and its repayment. The loan amount borrowed, the interest rate, the total finance charges that you'll pay over the life of the loan, and the repayment schedule. In addition, the disclosure must state what fees you'll have to pay if your payments are late, as well as whether you'll have to pay extra fees if you pay off your loan early. The disclosure must also state what security or collateral you are required to post for the loan. As I mentioned in a previous lecture, the item that's being purchased with the loan is often the collateral. For example, most car loans require the car that's being purchased with the loan to be used as collateral for the loan. Also, if the lender offers you any kind of insurance in connection with the loan, either to insure the collateral or to insure you in case you can't repay, then they're required to disclose the price of the insurance that they're offering. The Truth in Lending Act is part of the loan contract, but not all of it. Let's look at the other paragraphs in the contract and see what their purposes are. The paragraphs are placed in two big sections, one called Note and the other called Security Agreement. The Note part of the contract contains further descriptions of the loan and some provisions for enforcement. The Security Agreement part of the contract is basically a set of covenants for the promissory note that revolve around the collateral. In the Note section, the paragraph called Promise to Pay simply spells out that the borrower is promising to repay the full loan amount and interest to the lender. The paragraph on payments spells out that the borrower is promising to make the payments described in the corresponding section of the Truth in Lending disclosure. Note that the payments paragraph also spells out that the borrower must direct the payments to where the lender wants them to go. The Note section also has a paragraph called Security Interest, which explicitly spells out that the items listed in the security section of the Truth in Lending disclosure are being used as collateral for the loan. I'll have to explain about this a little bit more in a minute. The remaining paragraphs in the Note section are enforcement provisions. The paragraph called Default spells out all the circumstances in which the lender will be declared in default on the loan. And then it says that an acceleration clause will be triggered if the borrower is declared to be in default. The provisions for seizing the collateral are given in the security agreement part of this particular promissory note. The security agreement part of the promissory note starts with a paragraph that explicitly states that the borrower is using the items listed in the Truth in Lending disclosure as collateral. The legal term used is security interest. The use of the term security interest in reference to the collateral is very common in financial contracts, and it's related to another term that's also commonly used to describe a loan, the word secured. If a loan is secured, this means that the borrower is using collateral. The borrower allows the lender to take a security interest in an item owned by the borrower. In an unsecured loan, on the other hand, it's simply a loan that isn't backed by a specific collateral. Note that if a loan is unsecured, It doesn't mean that the lender is out of luck if the borrower defaults. It just means that there's no specific item that the lender can lay claim to. If a borrower defaults on an unsecured loan, the lender will have to go to court and try to force the borrower to use some of their resources, whatever they may be, to repay the loan. And as you might expect, this process can be long and costly. It's much faster and cheaper for the lender if they can repossess a specific piece of collateral. That gives yet another reason why the use of collateral in lending is so prevalent. Well, back to the security agreement section of the promissory note. This section lists several covenants that relate specifically to the collateral. First, there's a paragraph titled Ownership of the Property, which requires you to use the loan to buy the item that you say you're going to buy. That's a positive covenant. The paragraph also contains a negative covenant. It says that you may not use the item as collateral for another loan until this loan has been repaid. Most of the remaining covenants in the security agreement part of the contract are positive covenants that require the borrower to take good care of the collateral. In fact, the first line in the paragraph entitled Use of the Property says specifically that you promise to use the property carefully and keep it in good repair. In addition to using the property carefully, the lender often requires the property to be insured against loss and damage. There's an entire paragraph devoted to this, and you may also remember that the Truth in Lending disclosure also mentions insurance. Requiring the borrower to take out insurance on the collateral helps to preserve the value of the collateral, no matter what happens. Remember from the lecture on information that collateral plays a big role in reducing those moral hazard and adverse selection problems in lending, but only if the collateral keeps its value. So insurance covenants are not only about making sure that the lender can be paid if the borrower defaults, they're also important for giving the borrower the incentive to keep paying the loan and stay out of default in the first place. Even with the best intentions and insurance, some borrowers are still going to default. The security agreement part of the contract spells out what will happen to the collateral in case this happens, in a paragraph that is titled, What Happens If You Are in Default? The lender makes it explicit that if the borrower defaults, the lender can take the collateral without going to court. Also, the lender doesn't have to give the borrower advance notice that they're going to repossess the collateral. In the case of car loans, or any loan where the collateral is highly mobile, you can probably guess why the lender will want to have that condition placed in the contract. This paragraph also specifies that once the lender has taken possession of the collateral, they can sell it and then use the money from the sale to pay off what the borrower owes. Well, that covers most of the substantive parts of the car loan contract. We've seen that this contract contains information describing the financial exchange, positive and negative covenants, and enforcement mechanisms. But there's probably still one thing you're not quite totally comfortable yet. Where do the numbers come from? How does the lender come up with a monthly payment? Well, let's look at the two main types of loans that most people take out and learn about where all the numbers regarding payments and finance charges come from. We'll use our example of the car loan to talk about the first type of loan contract that most people use. It's called an amortizing loan. In an amortizing loan, the loan principal is gradually paid back over the life of the loan so that each payment pays some interest to the lender and it also pays back some of the loan principal. In most amortizing consumer loans, like car loans and mortgages, the payments are all the same amount and they're made monthly. Now remember that earlier I emphasized the fact that financial contracts are agreements to exchange two things of equal value. This helps us to think about how to calculate the monthly payment on an amortizing loan. In the case of a 4-year car loan of $40,000, the lender and the borrower agree that the value of the 48 equal monthly payments is exactly equal to $40,000. And keep in mind that the payments are not just principal, but they have to contain the right amount of interest too. So it sounds like a terribly complicated math problem to figure out what the payments would be, right? Well, actually, it's not bad at all if you know a special mathematical tool called the annuity formula. The annuity formula is known in finance as one of the basic formulas for calculating the time value of money. It makes concrete the idea that money promised to you in the future isn't worth as much as cash in hand today. And one of the most common applications of this formula is to find the payment amount for an amortizing loan. Here's the general formula. We start with principal and set it equal to the difference between two fractions. The first fraction is the payment divided by I. And then from that fraction, we subtract another fraction, which is payment divided by a longer quantity. I times the quantity 1 plus I raised to the nth power. So payment is the amount of the payment, I is the interest rate, and n is the number of payments. Now, if you look at that formula and write it down and stare at it, you realize that you can simplify it. What I've done is I've described it in more broad terms so that it's easier to describe for me verbally. Then you can write it down and look at it, and then work with it if you want to do calculations with it. This formula captures the basic exchange of value in the loan contract. On the left-hand side of the formula is the loan principal, which is the amount of cash that the lender is handing over to the borrower. On the right-hand side of the formula is an expression that gives the value of the payments that the borrower is promising to make. We can fill in the numbers from our loan agreement and then simply solve for the payment amount. For our car loan example, $40,000 is the loan principal, the number of payments is 48, and the interest rate is, well, we have to be careful here. For the annuity formula to work, the interest rate has to match the time period covered by each payment. Since each payment covers 1 month, then the interest rate has to be the interest rate for 1 month. Now, the Truth in Lending Act requires the lender to tell the borrower what the annual percentage rate, or APR, is on the loan. This requirement came about because there are actually lots of different ways to quote interest rates, and the law requires every lender to use the same way so that borrowers can easily compare interest rates across lenders. The APR is an annual rate that makes interest rates easier to understand and compare, but it's not a monthly rate that can be plugged into most payment and interest calculations. Fortunately, though, for a monthly loan, the monthly interest rate is the APR divided by 12. So if the APR for the car loan is 6%, then the number we use in the formula for the monthly I, or interest, will be 6%, or 0.06, divided by 12, which is 0.005. That's 1/2 of 1%. So now, if we substitute these numbers into the annuity formula, we get that $40,000, that's the principal, is equal to payment, which we want to solve for, divided by 0.005, minus the second fraction, payment, divided by 0.005, times 1.005, where the 1.005 is raised to the 48th power. Now that's actually easy to solve for the payment if you have a calculator or a spreadsheet handy. When I do, I get that the payment is equal to $939.40, rounded to the nearest penny. Well, hopefully, that unravels one of the great mysteries of borrowing for you: how monthly payments on an amortizing loan are calculated. Well, let's try to tackle another: credit card finance charges. Credit cards are an example of the second major type of loan that people take out. This second type of loan is called a revolving loan. With a revolving loan, the borrower is free to pay back the full loan amount at any time, but doesn't have to. If the loan isn't paid off at the end of a month, then the lender adds a finance charge to the amount of the loan that hasn't been paid off, and that becomes the new total amount of the loan. In the case of credit cards, this is complicated a bit by the so-called grace period on new purchases. Most credit card lenders won't charge interest on new purchases for some amount of time, usually between 21 and 28 days, provided that the person had a zero balance on the card to start with. This gives people a chance to avoid paying interest at all if they always pay off the full balance on their credit cards each month. But if you don't pay off the full balance each month, then the credit card lender will charge interest in the following way. First, the lender calculates the average daily balance on your credit card account. Each day, the lender starts with yesterday's balance and adds new purchases that come in that day and subtracts any payments and credits that come in that day. That leaves the balance for that particular day. Then, the lender takes a simple average of all the daily balances for the days in the billing cycle. Since the credit card lender looks at things on a daily basis but bills you monthly, this means that different months have different numbers of days in them. That's why your monthly credit card bill will always have a line on it telling you how many days were actually included in this month's billing cycle. Credit card lenders charge interest based on your average daily balance. To do this, they need to use a one-day interest rate. Just as in the example of the car loan, we find this daily rate by taking the APR and dividing. In the case of daily rates, we assume that each year has 365 days, so the daily rate is the APR divided by 365. If the credit card's APR is 18% or 0.18, the one-day interest rate used to find the interest on the average daily balance will be 0.18 divided by 365, or 0.0004932. So this daily interest rate is multiplied by the average daily balance, which gives the interest charge for one day. This number is then multiplied by the number of days in the billing cycle to get the total finance charge for the month. For example, suppose you carry an average daily balance of $800 on your credit card one month, and there are 31 days in the billing cycle. Given an APR of 18%, your finance charge for the month will be $12.23, rounded to the nearest penny. Well, hopefully that raises your comfort level a bit with where the numbers are coming from on a credit card statement. While we're on the subject of credit card statements, let's talk a little bit about the minimum payments and the minimum payment warning that credit card lenders are now required to put on monthly credit card statements. Credit card lenders require you to make a minimum monthly payment on your balance, which is either a fixed amount or a percent of the balance if it's very large. The purpose of the minimum payment is to ensure that the borrower will actually pay off the balance, well, eventually. The problem, of course, is that minimum payments are pretty minimal, so it can take a really long time to pay off a credit card if you only make the minimum payment. Because too many consumers thought that minimum payments were all they really needed to make on their credit cards, the government now requires lenders to tell you about how long it will actually take to pay off your balance if you only make the minimum payment. And the warning shows you how much faster you'll pay off your balance if you make a higher payment, say $100 a month. If you do carry a credit card balance, it's worth paying attention to the information in this warning. And if you're accustomed to paying the minimum balance, then give some thought to making a higher payment each month. Wow, we've covered a lot of detailed information about financial contracts in this lecture, including some information that I hope you can use to understand your finances better, and maybe even make some changes. But what I really hope you've gained from the lecture is a higher comfort level with financial contracts. We all know that the fine print in a contract is important, and now we have a better understanding why. All these paragraphs and clauses contain important instructions and restrictions for the parties involved, and they lay out the penalties for not following them. So the next time you find yourself being asked to sign a loan document or any other financial contract, read it carefully, and don't be shy about asking what something means. Don't sign off on anything that you don't understand. And if someone tries to tell you you don't need to worry about some clause, just ask them, then why is it in the contract? In this lecture, I focused on loan contracts, and I've done that intentionally because over the next few lectures, we'll learn more about the main ways that borrowing and lending take place in the financial market. We'll start by learning about the standard way to borrow, at least the way that most of us individuals think about when we think of borrowing. We'll go to the bank. There's something special about banks that not only makes them good lenders, but also makes them absolutely indispensable to the financial markets. We'll learn what that is in the next lecture.